Hello, and welcome back to Johan Videos. If your eyes are glued to the trading terminal right now, chances are you're experiencing a rush of excitement. The silver quotation is sitting at $98.54, inching closer to that $90 threshold. Green bars are lighting up your screen. You're watching a historic moment unfold right before you. We're just $1 shy of hitting triple digits in American markets. It almost feels like we've reached the destination. It feels like triumph is at hand. However, I'm here to share a critical insight with you. What's displayed on your monitor right now isn't the actual destination. It's an optical illusion. While Western traders are popping champagne at $90, the genuine marketplace, the tangible metal market in Asian territories, has just shifted the target completely. And this wasn't a minor adjustment of a few percentage points. They've relocated the entire playing field to a completely different arena. Fresh pricing intelligence has just come through from the Shanghai Futures Exchange. The figure isn't sitting at $100. It hasn't settled at $115 either. The number is $113. Take a moment to absorb that reality. $113 for each troy ounce. This revelation transforms the entire landscape. Over the past 2 days, the dominant story has been about bridging the pricing disconnect. The prevailing thought was that if American quotations climbed to $99, they would align with Chinese levels. The expectation was that the price differential would evaporate. Instead, the exact opposite scenario has materialized. The disconnect hasn't narrowed. It has exploded wider. We're now staring at a $14 differential between the New York Exchange and Shanghai operations. In financial markets, when you observe a $14 gap on an asset hovering around $90, this isn't merely a market inefficiency. This is the market screaming at maximum volume. It's telling you in no uncertain terms that the Western pricing structure is completely shattered at its foundation. Consider the fundamental mechanics of this arbitrage opportunity. If anyone can acquire physical silver bars in New York at $99 and immediately liquidate them in Shanghai at $113, they're locking in a 14% profit margin simply by transporting the metal from an undervalued location to where it's properly assessed. This dynamic creates a powerful vacuum effect. The American market has essentially become the global discount counter for silver. We represent the most affordable source on the entire planet for acquiring this metal. And precisely because we're offering the lowest prices, we're experiencing a full-scale raid. Every single ounce sitting in New York depositories is now a target for arbitrage operators. They're locking in the physical bars, executing delivery procedures, and arranging shipment to Asian markets to capture that $14 premium per ounce. This phenomenon explains the explosive price movement we're witnessing in today's session. What caused silver to rocket from $94 straight to $99 in one trading period? Was this driven by small retail traders speculating? Absolutely not. Was this a squeeze scenario? Definitely yes, but not the variety most people imagine. This was the market desperately attempting to halt the outflow. The New York quotation is frantically climbing higher, trying to reach a level that would stop the physical metal from exiting American territory. It's searching for balance, but here's the problem. Every time New York offers $99, or Shanghai counters with $113, China is maintaining its lead consistently. Their message is crystal clear: we will pay any price necessary. This is what I mean by the moving target. Western banking institutions are attempting to cap the price to protect their underwater short positions, while Eastern purchasing entities are elevating their bids to secure tangible metal. The consequence is that any theoretical ceiling for silver has been completely demolished. If your analysis suggested $100 was the peak, you're reading an outdated roadmap. $100 is now the baseline. With Shanghai conducting transactions at $113, the New York price of $99 creates a substantial 12% disconnect relative to international settlement prices, establishing a massive arbitrage window. This understanding is driving the panic buying we're observing at this very moment. Market professionals are recognizing that silver is pushing against the upper boundaries of its established trading range, indicating that the period of double-digit valuations is confronting its most formidable test to date. As American markets recalibrate to these international premiums, the present $99 level is being interpreted by sophisticated traders as a major undervaluation. But this situation transcends simple price mechanics. This is fundamentally about flow dynamics. A $14 spread guarantees that silver will move in only one direction: out of Western vaults and into Eastern reserves. The United States is experiencing a systematic drainage of strategic commodities because our financial infrastructure refuses to establish accurate pricing. We're essentially subsidizing the industrial expansion of our geopolitical competitors by maintaining artificially suppressed domestic silver prices. The data we've received characterizes this as a runaway market situation. That description is absolutely perfect. The price has broken free from its dollar denomination anchor. It's now connected to the physical reality of supply constraints and manufacturing demand in the world's production centers. And in those industrial hubs, Silver commands $113 per ounce. So what are the implications for the remainder of today's trading? We're positioned at $98.50. We're breathing down the neck of that $99 level. The psychological weight of the $100 mark is enormous, but the arbitrage pressure from $113 is significantly stronger. The arbitrage dynamics suggest powerful upward momentum toward the century mark. If that mental barrier gets shattered, many analysts view the Shanghai quotation of $113 as the logical next target for price exploration. Given that conventional technical resistance zones are presently undefined, the banking sector might attempt to mount a defense. They could try establishing a massive sell order at $100 to safeguard their options exposure. But here's their fundamental problem. How can they possibly defend $100 when the rest of the planet is transacting at $113? They simply cannot. If they're liquidating at $100, they're selling below global market value. They're essentially donating capital to the buyers. This is precisely why the short squeeze is approaching its final stage. The short sellers aren't merely battling bullish speculators. They're fighting against arbitrage mechanics. They're fighting the entire international logistics infrastructure. The $113 revelation is the alarm bell. It confirms that the rally to $99 wasn't a speculative bubble. It was a market correction. We're correcting in an upward direction. We're correcting toward genuine fair value. In the upcoming section of this analysis, we're going to examine the ramifications of this pricing gap. We have documentation showing that 4.2 million ounces of silver were extracted from COMEX depositories in just 24 hours. This is the direct consequence of that $14 differential. We're going to dissect the vault drainage. We're going to investigate who's removing the metal and explain why the collapse of registered stockpiles places the exchange in immediate jeopardy of a delivery default. The price signal is one thing, the vault reality is another. And at this moment, the reality is clear. The silver is evacuating the building. We've confirmed that Shanghai pricing stands at $113. We have confirmed New York is trading at $99. When you have a chasm that wide, physical assets begin relocating. Metal flows from locations where it's underappreciated to destinations where it's properly valued. And today we have concrete evidence proving this movement. We've scrutinized the most recent daily warehouse documentation from the CME Group. This documentation tracks the movement of silver bars into and out of COMEX-approved storage facilities. Typically, these reports are uneventful. A few thousand ounces arrive, a similar amount departs. It's background noise. But the report we received today isn't noise. It's a blaring alarm. In a single 24-hour window, over 4.2 million ounces of physical silver were withdrawn from the COMEX infrastructure. 4.2 million ounces. Let's put that into perspective. That represents approximately 130 metric tons of silver. This isn't a retail investor purchasing a tube of coins. This is a convoy of armored transport vehicles queued up at the loading facilities. This is a cargo aircraft being loaded to maximum capacity. This is a run on the bank. But this isn't a conventional bank run on cash deposits. This is a run on the metal bank. The entities with silver holdings in New York are executing withdrawals. They're extracting it from exchange custody. They're removing it from the official system. We need to examine precisely which depositories experienced drainage, because the names on this withdrawal list paint a disturbing picture. 1.2 million ounces departed from the CNT depository. 600,000 ounces left Asahi facilities. 1.6 million ounces were pulled from Loomis International and Brinks. But the most shocking figure involves JP Morgan. 1.28 million ounces were withdrawn from JP Morgan vaults. JP Morgan has been considered the fortress. They serve as custodian for the largest silver stockpile in the Western Hemisphere. For an entire decade, market participants believed JP Morgan was the ultimate backstop. The operating assumption was that during tight supply conditions, JPM would always have sufficient metal to lease into the market to stabilize situations. Well, the fortress has been penetrated. When you witness over 1 million ounces evacuating the JPM vault in 24 hours, it sends a clear message. The sophisticated money is no longer comfortable leaving their holdings inside the banking infrastructure. They're taking physical possession. They're relocating metal from financial storage into strategic reserves. What's driving this? The Shanghai price? If you own silver stored in the JPM vault and you see Shanghai transactions at $113, you face two options. You can liquidate it on COMEX for $99 and feel clever, or you can withdraw the physical metal, arrange transportation to China, and sell it for $113. You generate an additional $14 million simply by relocating the metal. This explains why vaults are hemorrhaging inventory. The arbitrage vacuum is extracting inventory from New York at an unsustainable velocity. But the most dangerous figure in this documentation isn't the total withdrawal volume. It's the collapse of the registered category. In the COMEX system, there are two classifications of silver. Eligible silver, which is simply stored there, and registered silver, which is designated as available for delivery against futures contracts. Registered silver is the actual float. It's the only metal that matters for the pricing mechanism. Yesterday, registered inventory plummeted by 1.7 million ounces. It has declined to just 114 million ounces. 114 million ounces. That sounds substantial, correct? But let's perform the calculation. At a price of $100 per ounce, the entire registered silver inventory of COMEX, the stockpile that underpins the entire global futures market, is valued at roughly $11 billion. 11 billion. That's insignificant. That's a rounding error for a technology corporation. Elon Musk could purchase the entire COMEX registered inventory with pocket change. The global financial architecture is leveraging a market backed by a tiny fraction of physical metal, and that fraction is leaking 4 million ounces daily. If the present rate of withdrawals persists, it will impose tremendous strain on available registered stockpiles. Analysts are monitoring closely to observe how the exchange handles these accelerating delivery demands in coming weeks. When that threshold is crossed, the price doesn't simply move to 113. It goes to no offer available. It goes vertical. The 4.2 million ounce raid represents the market positioning itself for the default scenario. The insiders are extracting their metal immediately while the doors remain open. They understand that once the registered figure drops below 100 million or 50 million, the exchange will modify the rules. They'll enforce cash settlement. They'll lock the gates. So the major players are exiting. They're taking their assets and leaving. This brings us to an important moment. I need to address something significant regarding this channel and the content you're receiving. We are Johan Videos. We are the authentic source of this analysis. We examine these warehouse reports in the early morning hours to locate these figures. We monitor the Shanghai Premium. We connect the patterns. However, we've observed a substantial increase in imitation channels. They're using similar branding. They're copying our content word for word and distributing it across Twitter, TikTok, and various platforms. I want to be crystal clear. We operate only one channel. It's this one. We are exclusively on YouTube. We don't maintain a Twitter account under any variation of our name. We don't promote cryptocurrency on Telegram. The other entities using similar branding are not connected with us. We don't accept responsibility for their content. We deliver this analysis with extensive research and only authenticated information because we respect you. We want you to have genuine data, not inferior copies. So, if you value the work we produce here, please help us safeguard this community. Please share this video. Your support enables us to continue. Let the algorithm recognize that you understand the distinction between authentic analysis and copycat content. Now, returning to the vault drainage. The collapse of registered inventory generates a leverage crisis. Every futures contract on COMEX represents 5,000 ounces of silver. The open interest, meaning the total contracts outstanding, represents hundreds of millions of ounces. The ratio of paper silver claims to registered physical silver is exploding. For every ounce of physical silver in registered vaults, there exist hundreds of ounces in paper claims. As long as nobody demands physical delivery, the system continues functioning. But the 4 million ounce withdrawal proves people are demanding the metal. Paper holders are attempting to become physical holders, and there aren't sufficient chairs when the music stops playing. This explains the $90 price level. The market is attempting to discover a price elevated enough to convince someone to sell. But who's selling? Is JPM selling? No, they withdrew 1.2 million ounces. Is C&T selling? No, they withdrew 1.2 million ounces. Is Asahi selling? No, they withdrew 600,000 ounces. The custodians are net accumulators. The entities operating the vaults are extracting the metal. If the vault operator is hoarding, what does that communicate about future pricing? It tells you that $99 is undervalued. It tells you that $113 is undervalued. We're witnessing the remonetization of silver. It's transitioning from a financial instrument traded for profit to a strategic commodity hoarded for survival. The Wednesday-Thursday heist is the signal that sophisticated capital has observed the Shanghai price and acted accordingly. They're arbitraging the system to collapse. In the following section of this analysis, we're going to examine the U.S. price catch-up. We're going to dissect the $99 level. Why does it matter? Why is the market hesitating right at the threshold of $100? And we're going to explain why weekend risk is forcing traders to liquidate their short positions. Nobody wants to hold short silver exposure heading into a weekend when Shanghai is transacting at $113. The gap is narrowing, but it isn't narrowing because Shanghai is declining. It's narrowing because New York is exploding upward. The vault is depleted, the price is accelerating, and the squeeze is entering its terminal phase. We've analyzed the $14 spread that emerged in Shanghai. We've analyzed the 4 million ounce hemorrhage in COMEX vaults. Now we must direct our focus to the chart flashing across every trading terminal in New York and Chicago. We're observing the silver price in the United States. And as I'm speaking, it's trading at $98.54. It's pushing, grinding, and clawing toward $99. This is the catch-up trade. For years, the United States COMEX was the dominant force. New York established the price and the global market followed. If New York sold, prices dropped in London and Shanghai. If New York bought, prices rose globally. But today, the polarity has inverted. China is the engine. The United States is the caboose. We're being dragged higher. The reason silver is hitting $99 in New York isn't because American investors suddenly developed an affection for the metal. It's because arbitrage mechanics are forcing the price upward. Think of it like water in two connected vessels. One vessel, Shanghai, is filled to the level of $113. The other vessel, New York, was sitting at $94. When you open the valve connecting them, which represents the global shipping network, water rushes from the high vessel to the low vessel until they reach equilibrium. The only method to stop the rushing water, the only way to halt the drain we discussed previously, is for the level in the New York vessel to rise. We're watching the water rise in real time. But $99 is a precarious number. It sits just below the psychological threshold of $100. In technical analysis, we frequently observe hesitation at these major round numbers. Traders become nervous, they secure profits. They think surely it cannot climb higher. But this time is different. Normally resistance levels hold because there's a wall of sellers waiting to exit. But ask yourself, who is selling at $90 when they know they can sell for $130 in China? The sell wall has vanished. There is no resistance because there are no sellers. The only sellers remaining are the naked shorts, the banks who are trapped. And they aren't selling because they choose to. They're selling because they're fighting for survival. But even they are running out of ammunition. This brings us to weekend risk. In a normal market, traders prefer to close positions flat for the weekend. They don't want to hold risky exposure while markets are closed. But in a breakout market, the risk profile inverts. The risk isn't holding the asset. The risk is not holding the asset. Imagine you're a hedge fund manager. You see silver at $99. You see Shanghai at $113. You see vaults draining. And you understand that over the weekend, anything could occur. China could announce a new export restriction. The US Mint could announce a permanent production halt. The Middle East could purchase another $1 billion worth. Those who have sold silver they don't physically possess are now trapped. You're wagering that nothing happens for 48 hours. That's a bet nobody wants to take. So what occurs on Friday? We anticipate observing a short covering rally. The traders holding short positions will panic. They'll repurchase their contracts to close positions before the weekend. They want to sleep peacefully. They don't want to wake Sunday evening to discover silver gapping to $110 in Asia. This fear of the gap is a powerful catalyst. It forces the price upward even without new information. The fear of what might happen is sufficient to drive the bid higher. And let's examine the $99 level itself. It's a signal. It's the market communicating that the double-digit era is concluding. When an asset transitions from $99 to $100, it changes asset classifications. At $99, silver remains a volatile commodity. It's something you trade. At $100, silver becomes a store of value. It joins the category of serious assets. It captures the attention of pension funds and family offices. The unit bias shifts. People stop perceiving it as expensive and start viewing it as valuable. Retail investors are rushing to secure physical bullion. They're looking at $99 and they aren't frightened. They're energized. They see the momentum. They see the strength and they want participation. But here's the trap for the uninformed buyer. They're purchasing the paper price. They're buying the $99 contract. They don't realize that contract is a claim on a vault bleeding 4 million ounces daily. They're entering a market segment confronting unprecedented physical supply constraints. The catch-up isn't just about price, it's about reality. The US market has been operating in a fantasy world where silver is inexpensive and plentiful. That fantasy is colliding with the reality of scarcity. As the price pushes through $99, it destroys the bearish case. The bears claimed silver was in surplus. The bears claimed industrial demand would collapse with a recession. The bears claimed high rates would crush precious metals. $99 proves them all incorrect. It proves the deficit is genuine. It proves industrial demand is inelastic. And it proves high rates don't matter when the currency itself is being questioned. So as we approach the Friday session, keep your focus on the spread. Current US price $99. Current Shanghai price $113. Spread $14. As long as that spread persists, the trend is upward. The arbitrage vacuum will not cease pulling until prices equalize. Because Shanghai represents the physical market, it's the heavy anchor. It isn't moving downward to meet New York. New York is dragging its anchor across the ocean floor to meet Shanghai. This is why we state that $100 is not a ceiling. It's a magnet. The banks can resist for a few hours. They can attempt to manipulate the tape, but they cannot fight the hydrodynamics of global capital flows. The capital is flowing to the metal. And right now, the metal is priced at $113. In the final section of this analysis, we are going to examine the triple-digit era. We are going to move beyond the $99 noise. We'll examine what occurs when the odometer rolls over. We are going to discuss the Veblen good effect, why elevated prices will actually generate more demand, not less. The caboose is catching up to the engine and the train is accelerating. We've analyzed the arbitrage vacuum and the vault hemorrhage. We've analyzed the price catch-up. Now we must focus on the most dangerous 48 hours, the weekend. It's Friday morning in New York. Silver price is hovering just under $99. The market is tense. The atmosphere is thick. You can almost sense the electricity emanating from the screens because in a runaway bull market, the Friday close is the most critical data point of the week. It reveals who controls the market. If the banks smash the price back to $95, they survive to fight another day. They signal to the market that resistance still exists. They create doubt. But if the bulls can maintain the line and close the week at 99, or heaven forbid breach $100, then the game transforms completely. A strong weekly close forces the algorithms to recalculate their risk models for the weekend gap. Let's discuss weekend risk. Imagine you're a commercial bank. You're short millions of ounces of silver. You're underwater. You're hemorrhaging capital. And you see Shanghai trading at 113s. You understand that the physical market doesn't sleep on weekends. While COMEX is closed, deals are still executing. Mines are being acquired. Refineries are being booked. Physical supply is relocating. If you go home Friday holding a massive short position, you're taking a gamble. You're betting no news breaks for 48 hours. You're betting China doesn't announce an export ban. You're betting the US Mint doesn't announce permanent closure. That's a terrifying wager. In a market this volatile, news has a tendency of breaking when markets are closed. If a headline hits Saturday, the price doesn't just tick upward, it gaps. It opens Sunday night $10 higher than Friday's close. If you're short and the market gaps up $10, you cannot exit. You're trapped. Your stop loss is worthless. You open the week insolvent. This fear of the gap is what drives short covering on Fridays. We anticipate observing the banks repurchasing their positions today, not because they want to establish long positions, but because they're too terrified to maintain short positions. They're flattening their books, they're reducing exposure, and when a short seller buys to cover, it functions just like a regular buy order. This creates a self-fulfilling prophecy. The fear of higher prices drives prices higher. And let's examine the technical setup at $100. In the options market, $100 is a massive strike price. There are thousands of call options positioned at that level. If price pushes through $100, market makers are forced to hedge. They must purchase futures contracts to offset risk. This is called a gamma squeeze. It acts like a magnet. The hedging purchases accelerate, pulling price even closer. It's a gravitational field. The banks are fighting gravity. They're attempting to hold price at $99 to prevent that gamma explosion. They're selling everything available to keep it in double digits, but they're fighting against the Shanghai spread. Remember, Shanghai is at $130. Every minute New York remains at 99, the arbitrage operators are backing up the truck. They're purchasing the cheap New York contracts to sell in China. So the banks are being attacked from both sides. The gamma is pulling them upward and the arbitrage is pulling them upward. The only force pushing downward is their own desperation. This is why we state the Friday close is the verdict. If we close strong, the Monday open will be violent. We're looking for a gap and go scenario. This is where the market opens significantly higher and never looks back. It leaves a gap on the chart that doesn't get filled for years. It's the signal that the asset has repriced. For the retail investor, this weekend is a test of nerves. You will observe volatility today. You might see a smash, you might see a rip, but you must keep your focus on the macro picture. The vault data, the 4.2 million ounce drain, doesn't care about the Friday close. That metal is gone. It isn't returning Monday. The shortage is structural. The price action is simply the market determining how severe the shortage truly is. So if we observe a smash today, do not panic. View it as weekend clearance. But if we observe a breakout, understand we are crossing the Rubicon. Once we trade in triple digits, the psychology of the entire world shifts. The unit bias kicks in. The media frenzy begins. We are standing on the precipice of a new era, the era of triple-digit silver. The banks know it, the miners know it, and the Chinese know it. The only people who don't know it yet are the general public. And they're about to discover when they turn on the news this weekend. In the final section of this analysis, we are going to examine the triple-digit era. We're going to map out what happens after we break 100. We're going to examine the targets, $150, $200. We're going to discuss the Veblen effect, how higher prices will actually create more demand from the public, not less. The week is ending, but the squeeze is just beginning. The gap is coming. We have reached the conclusion. If you have followed me through this analysis, you comprehend the magnitude of this moment. You understand the Shanghai breakout and the vault hemorrhage, and you understand the catch-up trade dragging the US price to $100. The evidence is overwhelming, it's forensic, it's undeniable. We are not observing a trading anomaly. We are observing the end of the double-digit era. For 50 years, silver has been a 2-digit asset. It was $10. It was $20. It was $50. But it never sustained 3 digits. Today, that transforms. The move to $99 is just the prelude, the warm-up act. The main event begins when we cross $100. And when we cross that line, the rules of economics are going to flip upside down. In a normal market, when price rises, demand declines. If hamburgers cost $100, people stop eating hamburgers. But silver is not a hamburger. It is a Veblen good. A rare economic phenomenon where demand actually increases as price rises. Why? Because the price itself is a signal of value and status. Think about a Rolex watch, or a Ferrari, or Bitcoin. People don't purchase them because they are inexpensive. They purchase them because they are expensive. They purchase them because the rising price confirms they are desirable. When silver hits $100, it stops being an inexpensive industrial metal. It becomes a precious monetary asset. The high price acts as a marketing campaign. It screams to the world, this is valuable, this is real money. Once a major psychological barrier like $100 is breached, the subsequent momentum can often accelerate into a new phase of price discovery. Why? Because the fear of missing out kicks in at the triple-digit level. The retail public will observe the headlines on the news, and they will think, oh no, I missed it. I need to get in before it goes to 200. This creates a buying panic. And remember, this panic is hitting a market with zero supply. The US Mint is closed. The dealers are rationed. The vaults are empty. So you have vertical demand meeting zero supply. That is a melt-up. So where does it stop? What is the target? If $100 is the floor, then what is the ceiling? To find the ceiling, we must examine gold. Gold is knocking on the door of $5,000. Throughout history, the natural ratio of gold to silver is roughly 15-1. If we apply that ratio to the current gold price, the math is staggering. $4,950 divided by 15 equals $330. Applying that 15-1 ratio, the theoretical valuation reaches over $300. By this metric, $99 silver is trading at a significant discount. It is one of the most undervalued assets in the current financial landscape. This is why the banks are terrified. They know this math. They know if the market reverts to the mean, their short positions will be vaporized. So what is your strategy for the triple-digit era? Consideration number 1, the long-term view on fiat currency. While taking profits is natural, consider the broader context of currency devaluation. But you must ask yourself, what are you winning? You're winning fiat currency being printed by the trillion to bail out the bond market. You're winning a currency the US Mint cannot even use to price its own coins. Exchanging silver for currency involves a choice between a physical asset and inflationary pressure. It is a decision that requires careful thought regarding your financial goals. Consideration number 2, asset rotation. Some investors hold until the metal can be exchanged for tangible income-producing assets. You wait for the mania to overshoot. Some holders track the silver to property ratio looking for a shift in purchasing power. They wait for the opportunity to exchange metal for significant real estate assets. Current levels are seen by many as the early stages of a longer valuation cycle. Consideration number 3, managing volatility. History shows that significant price movements are often accompanied by sharp pullbacks. Avoiding high leverage positions may help in navigating these turbulent phases. The volatility is the noise, the trend is the signal. The current technical indicators suggest a strong upward trajectory. The moving goalpost has moved to $113 in China. Soon, it will move to $150. The US market is just the tail of the dog, and the dog is running east. We are witnessing the greatest wealth transfer in history. It is moving from those who trust the paper to those who trust the metal. You are on the right side of the trade. You are on the right side of history. Institutional short positions are facing extreme pressure as vault inventories reach critical lows. The market is maintaining its position at 99.9. Stay informed by following the data and remain disciplined in your strategy. Keep your focus on the macro trends. This is the moment you have been waiting for. Thank you for being part of the Johan Videos community. We will continue to track this breakout every step of the way. Remember to check the channel. Remember to share the truth. The era of cheap silver is over. Welcome to the triple-digit era. Stay safe and hold the line. Subscribe.